Have you ever found yourself wondering, is renting really a waste of money? Or will I ever be able to afford a home of my own? Well, whether you're living in Des Moines or consider moving to Des Moines, understanding the real cost of renting versus owning a home is one of the most important financial decisions you'll make in your lifetime. In this video, we're diving deep into the real costs of renting versus owning, the financial and lifestyle benefits of each, and most importantly, actionable steps that you can take today to start your journey towards homeownership. By the end of this video, you'll have a clear path forward on whether renting or owning is right for you. And if you're looking to buy in the future, I'm going to walk you through exactly how to get there. Welcome to the channel. I'm Blake Alewelt, founder of the Bravo Ridge Group. I make videos to help people just like you make informed real estate decisions, whether it's buying, selling, or investing in real estate. If you're considering living in Des Moines or moving to Des Moines, hit that subscribe button because we break down everything you need to know about the local market here. And if you're looking outside of this market, I also provide consultations on how to increase your negotiability when looking to buy or sell a home. All right, let's jump into today's topic. Renting versus owning. What are the key differences? Let's start with the basics. Renting and owning each come with their own pros and cons, and the right choice depends on your lifestyle, finances, and long-term goals. Let's look at the money side of things first. When you're renting, your monthly rent payment and utilities are the most you'll pay for a period of time. Usually that's 12 months. The landlord will usually increase the rents over time as costs increase like taxes, insurance, and maintenance. But for that 12-month period, you're able to budget your income and expenses. Now, as a caveat to that, your payments go towards your landlord's mortgage, maintenance, insurance, and taxes, not towards building your wealth. Sure, it may feel like a simpler option, but you're essentially helping someone else build their real estate portfolio. Now, I'm an investor myself, and I will admit, I love to see my tenants moving into the home and getting settled in. But it is a business, and landlords do have to make enough money as that roof will eventually need to be replaced. The furnace, the AC, or water heater will need to be maintained and eventually replaced as well. But if you are renting, there is one thing I want you to ask your landlord. That is to have your rent payments get reported to the credit bureaus. We'll cover why later in the video. Now, when you own your home, every mortgage payment builds what is called equity. Essentially, it's money going back into your pocket instead of someone else's. It will be a little of each payment at first, but grow larger as you make more payments. Over time, that equity grows, and when you sell, you can use that money to upgrade to another home or fund another financial goal. But let's break down with real numbers. If you're renting, let's say you pay $1,500 a month in rent. If that doesn't increase, over 5 years, you will pay $90,000 to your landlord, and you walk away with nothing. Now let's cover you if you owned your own home. Say you were to buy a $250,000 home with 3.5% down payment and 7% interest. Your mortgage, insurance, and taxes will be around $2,100 a month. So yes, you might pay more up front, but over 5 years, most of that money will go towards your principal or equity. If you decide to sell later, you could walk away with $40,000 to $50,000 in home value gains instead of losing everything to rent. Now, renting can be sometimes cheaper in the short term, especially if you're avoiding property taxes, homeowners insurance, and maintenance costs. But historically, people who own their own homes have 40 times more net worth when we get older. Now let's cover the main difference: renting versus owning, flexibility or stability. When you rent, you're at the mercy of rent increases, lease renewals, and a landlord's decision to sell or renovate the property, which could make you leave a house at the most inopportune time. In many markets, including ours, rent prices rise every single year, and in some cases, renters are priced out of their own neighborhoods. On the flip side, owning gives you stability. If you have a fixed rate loan, your mortgage payment stays the same, and if you never have to worry about a landlord kicking you out. That said, renting does provide flexibility. If you're someone who moves frequently or isn't ready to commit to a long-term location yet, renting might be the better option for now. But if you plan on staying put for at least 3 to 5 years, buying is almost always the better financial decision. Now that we have covered the finances of it all, let's go over why homeownership is more attainable than you think. Many people assume that owning a home is out of reach because of high down payments, credit score requirements, or even student loan debt. But the truth is, buying a home is more achievable than you think if you know what you're doing. The main myth we hear a lot at the Bravo Ridge Group is that you need a 20% down payment. That's simply not true anymore. FHA loans require 3.5% to 10% down depending on your credit score. VA loans for veterans and active duty military require $0 down, and depending on your disability rating, the funding fee can be waived as well. USDA loans for homes in rural areas also require $0 down, and they don't require you to have some rural cabin in the middle of nowhere. Conventional loans often allow for as little as 3 to 5% down. That means if you're looking at a $250,000 home, you could potentially buy with as little as $7,500 to $12,500 down, not $50,000. And with one of my clients, they are getting a down payment and closing cost assistance, so he won't even have to pay the full down payment. Another myth that we hear all the time is that you need perfect credit to buy a home. While a higher credit score gets you a better interest rate, you can still buy a home with a score as low as 580 with an FHA loan, or even lower in some cases. It's exciting and a little scary to think about buying your first home. Even when you know you're ready to buy a house, you might not be sure where to begin. These tips for first-time homebuyers will help you navigate the process from start to finish. But before we cover the steps you can take to get out of renting and start owning your home, I ask that you hit the like and subscribe buttons down below. It's 100% free and helps our videos reach more people that can use our help. Now let's get back to the video. Step number 1, start saving early. When calculating how much money you need to buy a house, consider one-time expenses as well as new recurring bills. Here are the main upfront costs to consider when saving for the home. Down payment. Your down payment requirement will depend on the type of mortgage you choose and the lender. Some conventional loans aimed at first-time home buyers with excellent credit require as little as 3% down, but even a small down payment can be challenging to save. For example, a 3% down payment on that $250,000 home is still $7,500. Use a down payment calculator to decide on a goal, and then set up automatic transfers from your checking to your savings to get started. Then there's your closing costs. These are the fees and expenses you pay to finalize your mortgage, and typically range from 2% to 5% of the loan amount. Your closing costs on that $250,000 loan could be between $5,000 and $12,500. That's additional money you'd have to pay on top of your down payment. In a buyer's market, you can often ask the seller to pay a portion of your closing costs, and you can save on some expenses such as home inspections and insurance by shopping around. Then you have your move-in expenses. Remember to budget for these, which typically run around $2,500 for most local moves. Long distance moves can be very expensive, so keep that in mind. Number 2, decide how much home you can afford. Figure out how much you can safely spend on a house before you start to shop. There are home affordability calculators that can help with setting a price range based on your income, debt, down payment, credit score, and where you plan to live. Number 3, check and polish your credit. Your credit score will determine whether you qualify for a mortgage and affect the interest rate lenders will offer you. Having a higher score will generally get you a lower interest rate, so take these steps to polish your credit score to buy a house. The first being to get free copies of your credit reports from each of the 3 credit bureaus, Experian, Equifax, and TransUnion, and dispute any errors that could hurt your score. Then you want to make sure to pay all of your bills on time and keep credit card balances as low as possible. That doesn't mean to make the minimum payments. You want to pay them down to 0 as often as possible. I pay my own credit cards every night before bed to make sure I will never get a statement with a balance on it. Also, keep current credit cards open. Closing a card will increase the portion of available credit you use, which can actually lower your score. You also want to avoid opening new credit accounts while you're applying for mortgages. Opening new accounts could put a hard inquiry on your credit report and lower the overall average age of your credit accounts, which hurts your score. Number 4, explore your mortgage options. A variety of mortgages are available with varying down payment and eligibility requirements. Earlier, we went over the main categories of mortgages you can use to obtain great financing while not bringing too much to the table. You also have options when it comes to the mortgage term. Most home buyers opt for a 30-year fixed rate mortgage and has an interest rate that stays the same. A 15-year loan typically has a lower interest rate than a 30-year, but the monthly payments are larger. One thing to also consider long-term, 15-year mortgages pay more principal earlier on and not as much interest to the bank. Number 5, research first-time homebuyer assistance programs. Many states and some cities and counties offer first-time homebuyer programs, which often combine low interest rate loans with down payment assistance and closing cost assistance. If you meet low to moderate income benchmarks, you could qualify for a grant or a forgivable loan that doesn't need to be paid back. Tax credits, known as mortgage credit certificates, are also available through some first-time homebuyer programs. Number 6, Compare mortgage rates and fees. Plan to shop around for mortgage lenders and compare 3 to 5 different quotes. Doing so could save you thousands of dollars in interest over the lifetime of the loan. The Consumer Financial Protection Bureau recommends requesting loan estimates for the same type of mortgage from multiple lenders to compare the costs, including interest rates and origination fees. Lenders may offer the opportunity to buy discount points, which are fees that the borrower pays up front to lower the interest rate. Buying points can make sense if you have the money and plan to stay in the home for a long time. In a buyer's market, some sellers may offer to pay some or all of the buyer's points to close the deal. Number 7, gather your loan paperwork. Before you're approved for a mortgage, your lender will ask you for financial records to verify your income, assets, and debts. Here are things that you can have ready. Proof of income and employment, such as tax returns, W-2s, and 1099s. Statements for bank, retirement, and brokerage accounts. Records of debt payments, such as credit cards, student loans, auto loans, or any other real estate debt. Documentation of other events that impact your finances, such as divorce, bankruptcy, or foreclosure. You'll want to pull all these documents ahead of time to stay organized throughout the process. You'll need them for a mortgage pre-approval, as well as when you apply for the loan. Number 8. Get a pre-approval letter. A mortgage pre-approval is a lender's offer to loan you a certain amount under specific terms. Having a pre-approval letter shows home sellers and real estate agents that you are a serious buyer and can give you an edge over home shoppers who haven't taken this step yet. Apply for a pre-approval when you've saved up enough money towards your down payment and are ready to look at some homes. A lender will pull your credit and review the documents you organized in the previous step. Applying for pre-approval from more than one lender to shop rates shouldn't hurt your credit score as long as you apply for them within a limited time frame, such as 15 to 30 days. Number 9, choose a real estate agent carefully. I know how this sounds coming from an agent, but I stand behind this even if you choose to work with someone else. A good real estate agent will scour the market for homes that meet your needs and guide you through the negotiation and closing processes. When speaking with potential agents, ask about their experience helping first-time home buyers in your market and how they plan to help you find a home. Number 10, narrow down your ideal type of house and neighborhood. Weigh the pros and cons of different types of homes given your lifestyle and budget. An existing home generally costs less than buying a new construction home, but if local inventory is low and you have the means, a brand new home offers enticing options like customization. A condominium or townhome may be more affordable than a single family home, but shared walls with neighbors will mean less privacy. And don't forget to budget for homeowners association fees when shopping for condos and townhomes or houses in planned and gated communities. Then you have fixer-uppers or single-family homes in need of updates or repairs usually sell for less per square foot than move-in ready homes. However, you will need to budget extra for repairs and remodeling. There are renovation mortgages like the FHA 203K loan that can finance both the home price and the cost of improvements all in one loan. Think about your long-term needs and whether a starter home or forever home will meet them best. If you plan to start or expand your family, it may make sense to buy a home with a little extra room to grow. Research potential neighborhoods thoroughly, including property values, property taxes, and safety considerations. Choose one with amenities that are important to you, including schools and entertainment options. If you work away from home, test out the commute during rush hour to see just how long it will be. Number 11. Stick to your budget. To avoid financial stress down the road, set a price range based on your budget and then stick to it. A lender may offer to loan you more than what is comfortably affordable, or you may feel pressure to spend outside of your comfort zone to beat another buyer's offer in a bidding war. In a competitive market, consider looking at properties below your price limit to give some wiggle room for bidding. In a buyer's market, you may be able to view homes a bit above your limit. Your real estate agent can suggest a range for your offering price. Number 12, make the most of walkthroughs and open houses. Thanks to technology, online 3D home tours have become very popular as technology improves. They don't supply all the information in-person visits do, like how the carpets smell, for instance, but they can help you narrow the list of properties to visit. It's possible to buy a house sight unseen, but I definitely don't recommend it. It's always best to visit in person or have someone locally do it. Open your senses when walking the home. Listen to the noise, pay attention to any odors, and look at the overall condition of the home inside and out. Ask about the type and age of the electrical and plumbing systems, and even the roof. Which brings us to number 13. Don't skip the home inspections. A home inspection is a thorough assessment of the structure and mechanical systems. Professional inspectors look for potential problems so you can make an informed decision about buying the property. Here are some things to keep in mind. Standard inspections don't test for things like radon, mold, or pests. Understand what's included in the inspection and ask your agent what other inspections that you might need. Make sure the inspectors can get to every part of the house, such as the roof and any crawl spaces. And you don't have to attend the inspection, but it could be useful to be there. By following the inspectors around, you can get a better understanding of the home and ask questions on the spot. If you can't attend the inspections, review the reports with your agent carefully and ask about anything that's not clear. Number 14, negotiate with the seller. You may be able to save some money by asking the seller to pay for repairs in advance or lower the price to cover the cost of repairs that you'll have to make later. You may also ask the seller to pay some of the closing costs, like we stated before. But keep in mind that lenders may limit the portion of closing costs the seller can actually pay for. Your negotiating power will depend on the local market. It's tougher to drive a hard bargain when there are more buyers than homes for sale. Work with your real estate agent to understand the local market and strategize accordingly. Number 15. Buy adequate home insurance. Your lender will require you to buy homeowners insurance before closing the deal. Home insurance covers the cost to repair or replace your home and belongings if they're damaged by an incident covered in the policy. It also provides liability insurance if you're held responsible for an injury or an accident, like a UPS or FedEx driver falling while dropping off a package to your property. You also want to buy enough home insurance to cover the cost of rebuilding the home if it's destroyed. If you're looking to buy a home here, I know a few insurance brokers that look at many different insurance companies to give you a better quote. And at the end of the day, renting has its place, but owning a home is one of the best ways to build long-term wealth and financial security. If you're serious about moving from renting to home ownership, start planning as soon as possible. Set a savings goal, check your credit, and get in touch with a realtor who can guide you through the process. If you're living in Des Moines or thinking about moving to Des Moines, I'd love to help you achieve your goal of home ownership. Reach out anytime, and don't forget to hit the like and subscribe so you never miss out on the new videos each week. Sincerely, thank you for watching, and I'll see you in the next video.